Trump announced the United States is exiting NATO, the military alliance that has defined Western security for 75 years. This decision fundamentally restructures global defense spending and creates massive opportunities for specific defense stocks. European nations must dramatically increase military budgets to compensate for loss of American security guarantee. American defense companies will capture enormous contracts as Europe scrambles to build capabilities they've neglected for decades while relying on U.S. protection. Three specific defense stocks are positioned to deliver extraordinary returns as this historic shift unfolds. These aren't speculative bets. These are established companies with proven technologies that Europe desperately needs and will pay premium prices to acquire quickly. Buy these three stocks now before markets fully price in the implications and the easy gains disappear. Let me explain exactly why NATO exit forces European defense spending to surge, which three stocks capture this spending, and why acting now rather than waiting is critical. This is connecting observable geopolitical events to documented investment patterns from past defense buildups. The NATO framework allowed European nations to underspend on defense for decades. They contributed 1 to 2% of GDP, while treaty requires 2% and realistic defense needs demand 3 to 4%. The United States covered the gap, providing security umbrella that let Europe allocate budgets to social programs rather than military. Germany spent 1.4%, France spent 2% barely, Italy spent 1.5%. These nations have capable economies but inadequate militaries because they relied on American protection. Trump exiting NATO eliminates this American guarantee. European nations face immediate security crisis. Russia remains hostile and capable. China is increasingly aggressive globally. Middle East instability threatens energy supplies. Without American backing, Europe must defend itself. This requires tripling or quadrupling defense budgets within 5 to 10 years. Germany needs to increase defense spending from $60 billion to $200 billion annually. France from $50 billion to $150 billion. Italy from $30 billion to $100 billion. Across Europe, the increase totals over $500 billion annually in new defense spending. This spending focuses on capabilities Europe lacks. Air defense systems to protect against missiles and aircraft, fighter jets to establish air superiority, naval vessels to protect sea lanes, armored vehicles and artillery for ground forces, intelligence and surveillance systems. All of these require advanced technologies that American defense companies provide better than anyone else. European defense industries exist but lack scale and capabilities to meet urgent needs. They will turn to American suppliers who can deliver proven systems quickly. So which three stocks capture this opportunity? The framework requires companies with technologies Europe needs most urgently, established relationships with European militaries and production capacity to ramp quickly. These should be large established defense contractors rather than small speculative companies because Europe needs proven solutions immediately. Stock 1 is the leading missile and air defense systems manufacturer. This company produces Patriot missile defense systems, THAAD anti-ballistic missile systems, and various other air defense technologies. European nations face immediate threat from Russian missiles and need these systems desperately. Current orders are backlogged for years because existing customers cannot get enough production. European demand will add tens of billions in new orders over next decade. The specific business dynamics favor this company enormously. Air defense systems are complex technologies with few qualified suppliers globally. This company has dominant market position with proven combat effectiveness. Once a nation chooses this company's systems, they're locked in for decades through training, maintenance, and ammunition compatibility. The recurring revenue from support contracts often exceeds initial purchase price over system lifetime. Europe buying these systems creates 20 to 30-year revenue streams. Current market cap is approximately $130 billion with annual revenue of $40 billion. European NATO exit could add $20 billion in annual revenue within 5 years as nations urgently procure air defense. If revenue grows from $40 to $60 billion and profit margins expand modestly from scale, earnings could reach $6 billion annually. At 25 times earnings, which is reasonable for defense contractor with locked-in government contracts, that's $150 billion market cap. From $130 billion to $150 billion is 15% gain. But that's conservative. If urgency drives faster procurement and margins expand more, revenue could hit $70 billion with $8 billion earnings. At 30 times earnings, given the growth and strategic importance, that's 240 billion market cap. From 130 to 240 billion is 85% gain over 5 years. Stock 2 is the premier fighter jet manufacturer producing the F-35 Joint Strike Fighter that multiple European nations already operate, and many more will need to purchase. The F-35 program is most advanced fighter aircraft in production with capabilities far exceeding older European designs. Nations needing to rapidly modernize air forces will accelerate F-35 purchases because the aircraft is proven and available rather than waiting for European alternatives that may never materialize. The F-35 business model provides extraordinary economics. Each aircraft costs approximately $80 million, with nations typically ordering 50 to 100 aircraft. But the real value is lifetime support contracts. Each F-35 requires approximately $30 million in maintenance and upgrades over its 30-year service life. A nation buying 50 aircraft for $4 billion will spend another $15 billion on support. This company captures most of that support revenue, creating predictable cash flows for decades. Current market cap is $110 billion, with F-35 representing major portion of business. European nations could order additional 500 to 1,000 F-35s beyond current commitments if NATO exit accelerates modernization. At $80 million per aircraft, that's $40 to $80 billion in aircraft sales plus support contracts of similar magnitude. This doubles the F-35 backlog, creating visibility for 10 to 15 years of production. Stock price reflects current orders but not the acceleration from European urgency. As orders materialize, the stock reprices higher. From $110 billion to $160 billion or more is realistic as European procurement becomes clear. Stock 3 is diversified defense contractor providing intelligence systems, cybersecurity solutions, satellite communications, and advanced electronics for military applications. These capabilities are exactly what Europe needs to operate independently from American intelligence sharing and command systems. European nations must build autonomous military capabilities, which requires massive investment in these technologies. The specific products this company offers include secure communications networks for military forces, satellite systems for reconnaissance and communications, electronic warfare systems to jam enemy radars and communications, and cybersecurity infrastructure to protect military networks. European militaries currently depend on American systems for many of these functions. Independence requires procuring equivalent capabilities from companies that can deliver proven solutions quickly. This company has all these technologies and existing relationships with European defense ministries. Current market cap is $60 billion, with annual revenue of $20 billion, focused heavily on intelligence and communication systems. European procurement could add $10 billion in annual revenue over the next 5 to 7 years as nations build independent capabilities. This 50% revenue increase with operating leverage driving margin expansion could increase earnings from $2 billion to $4 billion annually. At 25 times earnings, that's $100 billion market cap. From 60 to 100 billion is 67% gain. The potential is actually higher because these systems create decades of recurring revenue through upgrades and support, similar to the missile defense contractor. The common thread across all three stocks is they provide critical capabilities that European nations cannot develop quickly themselves and must procure from established suppliers. The urgency from NATO exit eliminates normal budget constraints. When national security is at stake, governments pay whatever is required. These companies will capture premium pricing and accelerated orders that drive revenues and profits far above current expectations. The timing matters because defense stocks move on order announcements and budget commitments. Once European nations formally announce major procurement programs, which will happen within months of NATO exit, these stocks will surge as markets recognize the magnitude of new business. Waiting for confirmation means buying after the initial move. Positioning now captures the full revaluation as the market gradually recognizes what European defense spending surge means for these companies. The risk factors include possibility that Trump reverses NATO exit decision, European nations failing to actually increase defense spending despite commitments, or European domestic production capturing more business than expected. These risks keep current valuations reasonable, but evaluating probabilities, NATO exit appears increasingly likely. European security situation demands increased spending regardless of what they prefer, and American technological advantages make these companies the logical suppliers. The risks are manageable relative to the opportunity. The portfolio allocation should reflect conviction while managing single stock risk. Perhaps 30% in the missile defense contractor, 30% in the fighter jet manufacturer, and 40% in the diversified intelligence systems provider. This balances exposure across the companies while providing meaningful participation in the defense spending surge. This is not small speculative position. This is major portfolio allocation based on high conviction thesis about structural change in defense spending. Buy these 3 defense stocks now. The leading missile and air defense manufacturer will capture tens of billions in European orders for Patriot and THAAD systems, creating decades of recurring revenue. The F-35 fighter jet producer will see accelerated orders for 500 to 1,000 additional aircraft, plus support contracts doubling the program backlog. The intelligence and communication systems contractor will provide critical capabilities for European military independence, adding billions in new revenue. Trump exiting NATO is the catalyst that forces European defense spending to surge. These 3 companies are best positioned to capture this spending. Position now before order announcements drive stocks substantially higher and the opportunity diminishes.